panel is going to talk a little bit about the multifamily space, and then we're going to get into our panel, okay? So, elephant in the room. It's kind of changing month to month, right? What is the elephant in the room? And right now, it's the United States. It's this guy. This guy that we probably all are familiar with. A lot of what he does and the calls that he makes affect our market. They affect mostly the macroeconomic environment. And what that does is it eliminates confidence, or really inhibits the ability for clients to make educated decisions with something of the magnitude like real estate. We're still buying our morning coffees, right? There's a lot of them here. We're still buying a new pair of shoes when we get salt all over them after a snowstorm. Okay, we're still buying little things, but not nearly as much as we could be and should be. That's why big part of why we are where we are. The reason for that stunted growth is the uncertainty that's provided because of this. But as we move forward, we realize that it's no longer just one elephant in the room. There's a lot of elephants in the room. We're talking about inflation. We're talking about jobs markets. We're talking about pre-construction markets. We're talking about where the money is. We're talking about inflation and interest rates. We're talking about a lack of inventory. So we're going to cover a lot of high-level points today and try to keep it as fun and exciting as possible. Sound fair enough?
Fair enough.
All right, cool. You're still there. That's good. So how did we get here? Bob Marley's got a few really good quotes in his lyrics, right? If you don't know where you're from, you don't know where you're going. So to understand where we are and to give context on where we are, we've got to talk about why we're here. So look, what does a pandemic do? Okay, any kind of global catastrophe, we'll call it, right? Terrorist attacks, 9/11, pandemics, war. Generally, they accelerate existing trends. And the existing trends in our housing market were quite good, quite positive. And when you make money very cheap, almost free, which is the only tool the government had to devalue their debt during the pandemic, right? There's three things the government can do to reduce their debt. Number one is reduce interest rates. They did. They were next to zero. The other is you can increase outputs. Borders were closed. It wasn't really happening, not a viable solution. The other option, or the last tool at their disposal, is to ramp up inflation. They ramp up inflation by making money more accessible, right? Reducing interest rates, and devaluing currency. Inflation essentially makes your dollars worth less. How much was milk back in 1970? You. Oh, what did she pay? 50 cents?
You got the milk for free.
You got the milk for free? Probably $1. I just bought organic milk today, and it's organic milk, so it's probably a little more, but $14 for a 2-liter jug of organic milk, $14. That's inflation. To buy the same thing you could buy in the past, it costs more dollars today, okay? And debt, it works in the inverse. So with debt, if you're taking on a large amount of debt, if you've got $1 million mortgage, you owe that money, same idea, higher inflation erodes that debt. So it actually made sense to borrow at this time, okay? But that's essentially why we cut rates as quickly as we did. Inflation went crazy, okay? Post-pandemic, what did we do? We raised rates. We had to raise rates to come back to earth, right? We can't have runaway inflation. We hit double-digit inflation, which is wild. And the government's only tool to reduce inflation is make money more expensive and limit spending. We were spending too much. We were able to effectively do that via monetary policy tools, and it ultimately stunted the market, created a big cause of uncertainty, okay? This is what happened next. Rates were hiked aggressively to curb that inflation that we were seeing. We're in a position now where rates are starting to normalize as a result of that roller coaster we had, okay? And we'll talk about kind of a little bit what we see in terms of outlook as we go. What happened when money was cheap is we ignored the fundamentals. Anyone ever buy an NFT? Probably too nervous to raise your hand because that is a little embarrassing. Sorry. Crypto. It's a good thing you don't know. It's an electronic photo, basically, right? Is that what it is? An electronic photo, right? So look, we got carried away with attributing value to elements that didn't make sense. Investors lost sight of what was relevant, what was important in a market, right? What's important? Location, rental demand, reversion, cash flow, access to transit and infrastructure growth, population growth, income, There's a lot of elements we have to look at to decide if an investment is worthwhile. But because of the frenzy, because of the craze, we kind of followed the herd. We're at a point now where there's a ton of opportunity that exists in the market, but we're now still following the herd, which screwed us last time. We're doing it again. It's going to screw you this time if we're not excited and confident in the outlook and taking the action we can take to take advantage of this lower volume market. So here, where are we now? Let's talk about where we're at, how we arrived here. Well, obviously you know where you are. You're at Guelph Humber University, right? You found it. Obviously, that's where we are here. I'm not talking about geography, I'm talking about market-wise. Where are we from a macro perspective? Well, there's a lot going on. The macro environment as a consensus, the Canadian economists as a whole, have kind of put out there that we're not expecting any rate hikes in 2026. What does this do? Welcome. What does this do? Well, it provides that confidence to make decisions. So where we're at now is we're starting to see transaction volume come back. We're starting to see questions being asked. We're starting to see an intuitiveness and a curiosity to look into the real estate again. It's been stagnant for 4 years. But with this one little bit of confidence, a little bit of confidence in the outlook, no one has a crystal ball, but data helps us with the next best thing. It helps shed clarity and provide a sense of confidence and predictability. And when the mass markets, right, the average consumer is investing their nest egg, $100,000, $200,000, $1 million, $2 million, into the largest asset class in the world, they want to be a little more confident than doubtful that we're on a good trajectory. Okay? So there's something I talk about a lot with business and in sales and markets overall, and it's basically understanding position versus trajectory. A lot of us are in the position that we're in today, and the market is in the position that it's in today because of what's happened in the past. You can't change that, right? Our position is our position. And if we are too focused on our position, we get frustrated, we get stunted, we don't take action. If we can focus on trajectory and what happens next and what little changes we have to make so that our position will be changed in a year from now, 2 years from now, 5 years from now, whether it be financially or fitness or whatever goals you have in mind, trajectory is more important to focus on rather than position. Fair enough? So let's talk about trajectory. Condo market first. We'll talk to the condo market. I mean, these things, these graphs, these numbers are wild. Wild to me. At a very high level, this is GTA specific, Toronto, we're not building anything. So it's not only the consumer that lost confidence in the outlook, but guess what happened for developers? A unit of housing is a product, right? If this iPhone cost $100 to make and sold for $200, is that a good business? Yes or no? Yeah. Sure, right? Pretty good. If this iPhone took $100 to make and the market would only pay $50 for it, what do you think Apple would do? They'd stop making it. They're going to shut down their manufacturing line, right? Take a break, everybody. See you when the market recovers. That's ultimately what happened in the development market, in the housing market. Costs went up. The consumer market wasn't there, couldn't justify the prices to be paid for pre-construction as a whole, so there hasn't been any development. There hasn't been any shovels in the ground, or a lot less, okay? With that being said, housing is not like an iPhone. It's not like if you need more of it, you just turn up the speed on the conveyor belt, if you will. Do you know the average timeline? If I was to buy the gas station across the street and build a condo, Noel buys a condo. By the time Noel's walking into his brand new unit, do you know the average timeline for that? How long that would take? Any guesses, start to finish? 5 years? 7? 10? Anyone else? What do you think? By the time they sell the building, design the building, sell the building, shovels in the ground, get the permits, approvals with the city, build the thing, finish the thing, and then give you your key. On average, for a high-rise, 7 years. 7 years. So what we're going to see and what we can confidently predict is that with 4 years of stunted growth, stunted development, stunted launches, or non-existent launches, we can look to the future. And we can say, wow, in 2030, condo completions are going to be next to zero. What's the core fundamental of economics, supply and demand? And then you talk about the purpose-built rentals, right? There's a lot of developers now converting buildings to purpose-built rentals because the buyer market's not there. That's even inhibiting the resale market even more, right? There's not those buyer end user units being brought to market. Today, yes, today, we see a surplus of inventory. It bottlenecks. But it's not about making decisions with real estate. It's not about making decisions based on the numbers today. It's about what are the numbers going to look like going forward. What confident predictions can we make about where we are today and where we're headed? So, I mean, it's just wild. You see that red graph. This is the average from since 2010. Just let that sink in for a second. If there's no completions, what does that mean? There's no new units coming to the market. And if there's no new units coming to the market, but our immigration is still working, demographically, we're still getting older. We're still adding to the workforce. There's still a lot of businesses coming and launching and setting up headquarters in Toronto and the GTA. So there's going to be a demand. The demand in our market is insatiable. But the supply won't be there. What does that tell you? Prices you think are going to go up or go down? Up. Based on this stat exclusively, for sure. And then we talk about single-family homes. So it's not just the condo market, it's a single-family home market as well. Based on today, we're at the lowest intention of building since 1970 in the single-family space. Lowest intention of building since 1970. Now we're in something, I have a graph I'll tell you, but I'm going to skip to it now. It's called the concentric city model. And a concentric city model means that we have a nucleus, downtown Toronto core, and the result of the value on the periphery is directly correlated to that nucleus, to Toronto. If Toronto evaporates, then all those periphery markets evaporate. And what restricts the expansion and that urban sprawl, if you know that word, sprawl, we go further and further from that nucleus, we are restricted. We've got Greenbelt and we've got the lake. So we're very confined in terms of valuable land and valuable space. Single-family homes, despite the growth in condos and the creativity and innovation in the design of condos, right, appealing to a new audience, families and whatnot, single-family homes are always going to be a desirable asset class. And there's nothing new. There's nothing there. So even now, in this recovery mode, in terms of bottom, based on the data, we've hit the bottom, it's recovery mode now, but we're already seeing it. We're seeing it day to day in what we're selling. That single-family segment, that periphery market, within an hour from downtown core, 1.1 to 1.4 million, that's what's selling right now. Why? That demographic has been most stunted. But you know what's happening a lot is a lot of change in the emotional side. So the data is one thing, but then we relate the data to a profile. So you think, who's not buying? Well, what about the young people? Graduate school, get a job. They're not spending any money based on what we talked about before. Household savings are the highest they've been even during the pandemic, which speaks volumes. Life doesn't not happen. There's still kids being born, there's still raises, there's still marriage, there's still growth, there's still those natural reasons to move. And a lot of those natural reasons to move, the asset class they're looking at is single family. And if we're not building anything, then same idea, very similar to condos. Values have to go up. Now our GDP growth, take a second and have a look at that as I speak to GDP. The biggest reason our GDP has been stunted and lagging massively behind the United States is because we're not spending money. We're not confident in the economy. We're not confident in the outlook. And a lot of that reason is the volatility we've had and kind of the back and forth headlines. It's negative, it's doom and gloom. I'm not going to invest in this market. I'm not going to buy in this market. I'm going to rent a little bit longer. The main reason for this is that we're not spending money as a whole. As soon as we start to spend money again, which the trends are there as of today, as soon as we start to spend money again, GDP growth will return. But the main thing is the recovery is going to happen a lot faster than I think most of us anticipate. It's not going to be your average 3 to 6% year-over-year growth, and especially in particular asset classes, which we'll speak to. It's going to happen a lot more rapidly to get back to where we should be and need to be. Now, Canada's population, I mean, this is nuts, grew by over 1.2 million people just last year. And something I'm hearing a lot with my clients, and I want to shed some clarity on, is that as we've really reduced our immigration targets and we're limiting the growth in terms of population right now, government intervention, it's like, oh, well, we're only targeting 365,000 in 2026. I'm still not used to saying 2026. It's already like March almost, right? But we're not seeing the same volume. Isn't that interesting? I'm gonna explain why that's actually a really, really good thing. Long story short, people need homes. Largest disconnect between new builds, new housing units, and population growth was in our market here, Ontario. So yeah, there's a lot of talk about, Calgary market and better landlord rules, right? More landlord favored municipal laws, or intervention. There's a lot of talk about investing in like Dubai. I hear about Dubai all the time. Not a fan of that market. There's a lot of people looking outside of our market right now. But based on data, I still believe Ontario and GTA is the most attractive market to be investing in. Hands down. The data tells a clear story. It's not opinion, it's fact. No more building, incredible population growth, core fundamentals, supply and demand, and it's most prevalent here. So where do we go from here, right? What happens now? What's our heading? Well, I talked about the targets and what we're looking at. So 365 in 2027. But we're really reducing our immigration targets as we go forward overall, okay? And I want to speak to quality over quantity. Quality over quantity. And that's why we like to host events like this. If you're not following us on social media or anything, make sure you are so you don't miss future events. Because we like to educate the consumers. We like to educate you guys. We like to talk about what we know and what's relevant and what's not, because there's a lot of varying information. But anyhow, on that note, quality over quantity, I want to know, in your opinion, we could do it by show of hands, the stat is that 52% of immigrants coming to Canada are coming from one country. Which do you think that is? Who thinks India? Raise your hand up high. India? India? Okay, China? Anyone think China? Okay. Canada? Couple of you, okay. The US? No? Okay. One. Philippines? Interesting, okay. All right. Who said Canada? Anyone say Canada? Yeah, you're right. Isn't that interesting? How does that make sense, Ty? I'm walking out of this seminar, glad I got a free slice of pizza. This guy doesn't know what he's saying. How can you immigrate to Canada from Canada? What are you talking about? Non-permanent residents are becoming permanent residents. And the profile there, so they're already landed in Canada. The profile there are students getting a great education, getting a great job out of school, getting paid Canadian dollars, and registering with status in Canada. Now, what does this mean, Ty? Why do you mean quality over quantity? I'm not just talking about their education. I'm not just talking about their income levels. That 1.2 million number that we had in 2025, and this stat blew my mind when I read it. That 1.2 million number of immigration, generally what the profile looked like is you'd have one working person come over, husband or wife, come over, get a job, get sorted, assume one unit of housing, either a rental, generally a rental, possibly a buy. And then what they would do is they would sponsor their spouse and their 1, 2, 3, or 4 kids. So that quantity, that number, isn't reflective of the impact it has on our economy. Does that make sense? This 365 target now, 52% of them, young student, getting a job, earning a higher income, it's 1-to-1. It's one single person assuming one unit of housing. You find that as interesting as I did? I think that that is very, very, very interesting and speaks volumes to the core effect that immigration overall had. 1.2 million people, but really effectively maybe 250 units of housing consumed. Does that make sense? Versus 365,000 people, and for the sake of the example, 365,000 units of housing consumed. There's another trend I didn't put up here. It's the time it takes for a landed immigrant to buy a home. Generally, they rent first, right? They rent first. And they buy within 6 years. 4 to 6 is the average, 4 to 6. With this new cohort, what we're seeing is 2 years. Within 2 years, they're buying homes. So again, when I talk about speeding up trajectory, speeding up timelines, it's happening in real time with the data. Let's talk about consumer confidence. There's plenty of room to improve consumer confidence. Plenty of room. Plenty of room. But it's coming back. It's returning. Federal intervention with CMHC limits being increased, right? You can put less down on a larger asset class. Interest rates working their way down. A little more confidence in the economy overall. So the confidence is back. And to see transaction volume, we need confidence in the economy. Affordability is a big reason for that. Affordability is returning because of federal intervention, provincial intervention to a degree, lower interest rates, buyer incentives, price points, obviously. So the affordability is improving, and that's a trend that will probably stagnate in and around here. But affordability is back to late 2021 levels, which is wild to me. Now, more on the confidence front, why we believe that this trajectory is more aggressive than maybe the headlines would stand to mention, we're richer. You're richer than you think. Scotiabank paid me $100 to say that. My point is this, we have more money. We have more money. And when we have more money, when we stockpile money, this is one of the benefits of a recessionary environment. We get nervous. You ever watch those shows like those guys down in Texas and they build a bunker under their house? Like an apocalyptic bunker, right? Why do they do that? Generally, you see those built a lot more when there's more uncertainty or lack of confidence in the state of the global world, global affairs, right? More concern for warfare, people are going to build more bunkers. So what happens financially? It's the same thing. If we're less confident in the outlook, if we're less confident in having a job in 2 months, if we're less confident in interest rates, if we're less confident in the value of our home, we're going to stockpile. Not non-perishable foods, but money. We're going to save more. So in conjunction with net worth, household savings are the highest they've been since 1932, which is wild. Now, this is a big one, okay? A lot of things you'll hear online and headlines, they speak to the Canadian housing market, and I just want to shed some light on this for a moment. There is no Canadian housing market. There isn't one. Downtown Toronto, do you think there's any similarities to our housing market as there are in Yellowknife, way up north? Probably not. Different profiles, different building mechanisms, different jobs, different everything. Do you think Halifax is similar to Vancouver? No, not really, not at all. You think Toronto is similar to Montreal? Not really. Economically, numbers-wise, stats-wise, not at all. Quebec has seen immense growth, immense, which is wild because there's no reason for that. It's just a result that the biggest losers became the biggest winners. So when you look 1 year back, Quebec looks like they're doing a great job. When you go 5 years back, you see that they're even lower than kind of where they started. Okay, so it's all about understanding the data. When in doubt, zoom out, I often say. But when we're talking about Canadian stats or you hear about Canadian stats, ignore it. You got to get more specific. You got to talk about GTA or Halifax specifically or Calgary specifically, different rental profiles, different jobs, different economies, okay? I talk a lot about data. Data is important. It's the driver of how we make decisions generally, how we confirm decisions generally, but how we are instigated to make decisions, it's emotional. It's always emotional, always emotional. And these things don't change. That's why I talk about specific asset classes, not even, understanding a Canadian market versus a Toronto market exclusively, but also understanding a condo market versus a freehold market, a luxury market versus a studio condo market, a cottage market versus a single-family home market. Okay, because life happens. People are graduating school, having kids, getting married. People are dying and people are splitting up, right? There's good and bad, and those are all reasons to transact. That hasn't gone away. The average price in our GTA market has doubled every 11 to 12 years, based on an average real growth number of 6.27% year over year, compounded. This is despite the pandemic. This is despite terrorist attacks. This is despite war. This is despite political intervention. I want you to focus as much as possible on the big picture. Big picture is supply and demand, lack of future housing, and a desire for that housing. It's quite simple. So why should you care? How are you affected? What does this mean for you? Well, it helps you decipher and decide where you're going to invest your money. I mentioned this concentric city model. Downtown Toronto is the nucleus. Okay, we call that the central business district. And everything as a result spills out from there. When I did my master's degree, the whole focus was density. This was 2017, and it was density trends across the world. Right? You go to Europe, they live in 250 square feet. Where do you go when your buddy comes over for a glass of wine? Where do you go? You go downstairs. You go to the park. You go watch the soccer game. You go out. You go to the pizza joint at the bottom of your building, your apartment building. Us, for some reason, the North American buyer, it's all about like fencing yourself off in your home. We need everything and anything. And we saw that trend start to shift. Very interesting. COVID stunted that completely. So what we saw was incredible growth on the 4s and 5s, the periphery, the larger zoomed out periphery, and some stunt in the downtown core. As we go forward, it's going to completely be the inverse. Completely. Those density trends are going to return as you can walk to work again and return to work. Walk to the Jays game when we win the World Series this year, right? It's going to happen. Walk to the Leaf game, walk to the bar after work, pick up your milk and eggs on your way home because there's 3 grocery stores in your 7-minute walk, right? The conveniences of being downtown have ultimately returned, okay? Population density trends, we talk about density. Ontario, hands down, leaps and bounds ahead of anybody else in terms of density, right? People per square kilometer, incredible. Now, where's the opportunity? Look, Fundamentals, okay? We get back to fundamentals. Hey, Ty, my buddy's buying a timeshare in Barrie. It's a resort community in Barrie, but it's not on the water, it's inland, and it's gonna be half retirement community, half Airbnb, half resort. Stupid. People bought it. They bought everything. People bought everything and anything because there was that craze. So when I say we gotta get back to the fundamentals make you money, period. Okay? So the fundamentals that we look at are some of these points here. We talked about a few of them. When you're analyzing a market, when you're considering deploying capital as an end user or an investor, these are the big points you got to pay attention to and look at. When you're choosing an asset, you have to decide what kind of investor you want to be. You have to choose what kind of buyer you are. How invested you want to be in terms of your time. I own a number of rental properties, a few pre-con, but mostly rental properties. And people say, well, do you have them managed? No. I manage them myself. It's really easy to manage a property. You know what happens? I get a call, hey, Ty, the dishwasher broke. Okay, no problem. I go on Home Depot, I click buy, I send it to the address, generally the cheapest one. I buy it, send it to the address, I text my tenant, I say, hey, it's getting delivered Thursday between 2 and 4. Will you be home? Yep. Done. Do I need a property manager to do that? No. And that happens, what, once every 7 years, maybe? So the management element shouldn't scare you away from being a landlord. But when we talk about choosing assets, we have to relate the asset to those core fundamentals that I just spoke about. You're taking this and applying it to this. It's a layer, okay? So what about these assets in terms of the quality, the functionality, the uniqueness? And I'll tell you, what I really love about the market that we're in right now, like today, as of now, it's competitive. The developers are competing for your eyes. The builders are competing for your attention. And when we have to compete, we're forced to innovate. So when the market was going crazy from 2010 to 2020, let's call it, as a whole, well, 2022, when the market was going just insane, builders could build anything, someone would buy it. There was a massive buyer market, right? They'd buy anything. So there's no desire to invest in architecture, design, quality, amenities, tech. Now, based on the market conditions, everything that's getting launched and when capital gets deployed and what's being built, it's special. They're competing. The design is incredible. The architecture is wow. The finishes are impressive. The amenities are intentional. The functionality is really, really functional. So the quality of these new assets is quality. I'll speak to pre-con for a moment and why we love pre-construction, because it checks a lot of boxes for us. We're very specific in the pre-construction that we like and that we work with and that we will ever promote. I will tell you no if I think no. I'm not going to force you to do anything. You know, if you're very serious about buying that weird Barrie community I talked about, then hey, good luck to you. Put it beside your NFT. But my point with pre-con is you have to apply the fundamentals to your decision-making process. We didn't do that for a very long time. If we do that now, there's opportunity and there's money to be made. Okay? And this is a hands-off investment. I'll give you a minute for questions if there are any. Otherwise, I went a little longer than I wanted to, and we started later than I wanted to. Any questions? Any of that not make sense? Raise your hand if you feel like you have a little more clarity on the market. Raise it higher so I could see that it wasn't nobody. Okay, good, cool. Okay, thanks. So I'm going to bring up Anthony. Anthony's a partner of mine. We launched Tyler McClay Realty Group together. I've known him since we were like 3. We're both third-degree black belts, did karate together for a very long time. So he's going to speak for about 10 minutes on multifamily and tell you why that is another opportunity. Cool.
Thank you.
Go on, thanks.
Thank you, guys. When I got here today, I also had socks. And then I heard Tyler speak, and he also knocked my socks off.
Oh, stop it.
So, multifamily. I'm going to be talking about, originally I had 10 ideas why I love multifamily, why I believe it is the safest, most resilient asset class. 10 was kind of long, so then I reduced it to 3. And then 3 wasn't really all encompassing, so we landed on 4. And I know it's kind of a weird number, but follow me here. So the first one is pretty obvious and self-explanatory, but it's worth diving into. Housing is a basic human need. And why that matters is because when times get tough, when we're in a recession, when there's job loss, when you're self-employed and maybe work's not as busy as it once was, the very last thing that you will stop paying is your rent, right? I'm going to reduce my discretionary spending first. I'm going to stop eating out. Right now I play in 2 hockey leagues. If anyone plays hockey, it's not a cheap sport. I'll probably stop. Maybe I only play in 1 league. But generally, I'm going to reduce my spending before I stop paying for my housing. So that insulates me from market downturns in a sense. The second is also pretty obvious, but also worth diving into. My risk is spread across multiple tenants. Now keep in mind, multifamily doesn't have to be a 100-unit apartment building. It could be a 6-plex, an 8-plex, a 10-plex. But the fact of the matter is, when there's vacancy, market downturns, or tenant turnover, I am insulated from that. If I have a single family home and my single tenant leaves, I am left with 100% of my expenses. 100% of my mortgage, my property taxes, my insurance. If I have an 8-unit building and half my tenants leave, I'm still collecting half of my rent, and the bulk of my expenses, hopefully all of them, are still covered, or at least a portion. Fair enough?
Fair enough.
The third reason, now this is where it gets a little bit more sophisticated. Multifamily real estate is structurally insulated from interest rate volatility. And before I kind of dive into that, let's take a step back and look at two concepts, 2 notions. The first is that all else being equal, and all else is rarely equal, but follow me, all else being equal, interest rates are inversely correlated with housing prices. Interest rates go up, housing prices typically fall down. Interest rates go down, housing prices typically climb up. The second notion that's worth mentioning is that multifamily real estate, specifically 5 or more units, even though it's technically residential, it's a roof over someone's head, is actually considered a commercial asset. And when you're getting 5 or more units, you're getting a commercial loan. So it's treated like a commercial asset in the eyes of the lender. And the reason that matters is because commercial assets, specifically in this context, are valued based upon the income that they generate. They're valued like a business. So you don't come up with the value the same way that you would a single family home where you look at the fancy granite countertops and you compare it to your neighbor who backs onto the ravine. Instead, it is purely based on the numbers. What is the gross income? What are my expenses? And what is my net operating income? That is how a building is valued in the multifamily space. So let's come back to how multifamily is insulated from interest rate volatility. Well, let's look at a high interest rate environment. What happens when interest rates rise? Tyler touched upon it, the obvious factor. Money is more expensive, right? The cost of capital is now more expensive for me to borrow. If the cost of money is more expensive, fewer people will borrow, demand for housing diminishes, and that generally puts downward pressure on prices. But what's really, really unique about multifamily is in a high interest rate environment, many would-be buyers who wanted to purchase, who are going to qualify for that first mortgage, either can't qualify because rates are too high, especially with a stress test, or they simply don't want to pay that additional cost of higher interest rates. So what happens is a lot of these would-be buyers turn to the rental market by necessity. I wanted to buy that house, now I have to rent. What happens to the rental market? Demand increases. Once demand increases in the rental space, rental rates generally follow suit, and there's that upward pressure on rents. Well, if I own a 10-unit building and there's increased rental demand and rental rates increase, well, my bottom line, my net operating income of my multifamily building has also increased. Ultimately, the value of my building also increases. So multifamily sits in a really, really unique position where it's very well insulated from a high interest rate environment where all other asset classes are typically a little bit more affected. Make sense?
Yeah.
Low interest rate environment, this one's a lot simpler. Money's cheap, everyone wants to borrow, everyone starts buying, and rising tides raise all boats. And multifamily is one of those boats, right? Everyone benefits from a low interest rate environment. So that one's pretty simple. But the fact of the matter is, when it comes to multifamily, it's very, very uniquely positioned in that whether rates are going up, down, or sideways, it's generally pretty stable. Make sense? This final reason, number 4, the reason I love multifamily real estate is because the federal government of Canada loves multifamily. How do I know this? They actively incentivize builders, developers, and investors to build and buy more purpose-built rental housing. How do they incentivize us? They incentivize us by offering us the best loan terms on the planet for properties that qualify. Now, the property's qualifications is a whole separate conversation, as are the investor qualifications. But to make it quick and simple, the best loan terms on the planet for qualifying multifamily properties are as follows. You can buy with as little as 5% down. I can finance up to 95% of my property. Okay, keep in mind, again, this is at least 5 or more units. The second loan term is I can get up to a 50-year amortization to really maximize my monthly cash flow. Right? If I'm financing 95% of a building, it's probably going to be hard to be cash flow positive with a traditional 25-year amortization. You want to stretch that out and maximize your monthly payments. When I first told my father about this, who's invested in some real estate, he's like, 50 years, I'll be dead by then. That's not the point. The point is the cash flow, right? And lastly, you're getting well below prime interest rates. As of today, depending on the deal size, you're seeing deals getting funded anywhere from 3.5% to 4.5%. It's worth mentioning, multifamily specifically is the only asset class that receives this treatment from the federal government. Why does that matter? Because if I were to buy that same multifamily asset with traditional financing, you go to the typical banks, your TDs, your Scotias, et cetera, well, I'm going to need to put at least 25 to 30% down, as opposed to the 5%. I'm getting a 25-year amortization, so it's cut in half, and you're generally getting charged higher commercial rates. In today's market, that's probably like a 5 to 6-ish%. So by leveraging federally backed financing, the program is actually called the CMHC MLI Select. If you've ever heard of it, CMHC stands for the Canada Mortgage Housing Corporation. Most people who hear that name know that they provide mortgage insurance when you're putting less than 20% down on your primary residence. Most people don't know that they have a commercial lending arm. And their commercial lending arm is the arm that is federally mandated to build more purpose-built rental units. And they're providing the insurance on these loans, right? By leveraging this financing, I'm deploying my capital more efficiently, and I'm able to scale my portfolio a lot faster. So to recap, keep it quick and simple. The 4 reasons, like I said, 4 is kind of a weird number, but it worked. The 4 reasons why I love multifamily, why I believe it is the safest, most resilient asset class you can buy. It's a basic human need. When, pardon me, shit hits the fan, the last thing I'm going to stop paying for is my rent, right? Number 2, my risk is spread across multiple tenants. If I've got a 10-unit building and half my tenants are gone, I'm still insulated from that vacancy, from that tenant turnover. Number 3, whether interest rates are going up, down, or sideways, I am structurally insulated from that interest rate volatility. Because higher interest rates, all else being equal, generally drive the rental market. And lastly, the federal government provides unbeatable loan terms for qualifying multifamily real estate that allows us to deploy our capital a lot more efficiently. Any questions? I've got an example. I don't know if we have time for an example.
2 seconds.
Fly
Quick,
through it.
Fly through it.
Fly through it. So here's an example. Again, keep in mind, the purpose of this program is not for investors to get rich. It's for the federal government to solve a systemic issue of adding supply to our market, right? We hear it all the time, supply. Tyler touched upon it. We are lacking supply. Sure, right now there's a bit of an oversupply, but big picture, we're desperate for it. So the name of the game is new construction. This financing is also available for resale, but it's a lot better terms when you're going new construction. So here's an example of an 8-unit property. There are 4 one-bedroom suites, 4 3-bedroom suites. Just to give you an idea of how we structure this, all of these deals are conditional on getting that financing, right? I know there's a lot of fear in the market right now. If you buy pre-construction today, it's ready a year from now, 2 years from now, 4 years from now, it's not worth the same amount. A lot of these builders are offering price match guarantees where they'll match the appraised value. Right? So if the appraised value comes in lower, they will honor whatever the appraised value was. I won't go through each of these, but the financials that we're probably keen to see. This property, this Aplex, is being sold for $2.38 million. My 5% down payment on that is about $119,000. And on that $119,000, this property generates about $18,000 a year in net cash flow. So that $18,000 a year is after accounting for all my expenses. Property taxes, my maintenance, my insurance, my utilities. And then it's going above and beyond, and we're also adding allowances for things that we need to account for. Vacancy and bad debt, maintenance and repairs, Maybe we have a separate account for replacement reserves, right? I'll have to put in a new dishwasher, a new stove. So once we deduct all of those expenses, that is what you're left with, and you're left with about a 16% cash on cash return. So very, very difficult to achieve these returns with traditional financing. This program allows us to capitalize on that. And that's all for now. Thank you very much.
Thanks.
I don't know if we have time for questions for Anthony. I don't know if we have questions for Anthony.
Anthony's going to be here after. If that investment class speaks to you, definitely talk to Anthony. It's a great product to add to your portfolio. Thanks, Anthony. Thanks for that. Let's welcome our panel. Gary, Kaylee, Brandon, and Brad. Come on down. Thanks for coming, everybody. Can we get a bigger round of applause for these guys? Come on. These are very important people. Very important people. Thanks for coming, guys. Appreciate you. Kaylee, I know I already saw. You look so cool as always. Hey, thanks again. So I've known two of you for a while. Known Brad for a little bit. Met Brandon today. But Brad, actually, it's his wedding anniversary today?
It's my wife's birthday.
Oh, wife's birthday. I'm sorry. I thought it was wedding anniversary. So it's his wife's birthday and he's here. So how about that? Isn't that great? Let's give him 3 cheers for at least making the time. Hip, hip.
Hooray!
Hip, hip.
Hooray!
Hip, hip.
Hooray!
Tell my wife those were for her.
Yeah, they are. I'm going to just keep it super casual. Nothing crazy. You can bounce off each other. You guys are all experts in your field and your craft. If you guys read up on our expert panel, essentially, Brandon's on the equity side, capital raise side, right? Funding the builders that are building. So great to get that perspective, that early on perspective. Brad, phenomenal speaker, very smart man, running for Toronto mayor. So I'm a fan. He's got my vote, and hopefully we'll win some of yours today. Gary, I've known for a while.
I live in Arabic. What does that say? Place 30, so.
He's not the best, and the rated with honor. Gary, tell us who you are.
I'm with Curated Properties, president, principal. Yeah.
One of the best developers in the city. Is it wrong in the file, in the print too? Oh, okay, it's right in the print. Just the slide. Ignore the slide. Gary's a great guy. We were runners up in a very incredible competitive pickleball tournament one time. Runners up. We're gonna win the next one. I cry myself to sleep. And so Gary's on the development side, and then we've got Kaylee, one of the top salespeople in probably the world in pre-construction. Okay, so Kaylee can speak to what the consumers are actually saying today and what the hesitation is. Is that fair enough? Cool. So I've got some questions for all of you. You can all kind of bounce off. They all relate to your backgrounds. But Gary, I'll start with you. Just from a developer's lens, what's changed the most in build economics this cycle? Talking about labor, materials, finance costs, or municipal fees. What's the biggest hurdle and what's been the biggest shift that you've seen from that?
Well, the shift is obviously perception thing, and you hit on that. This is consumer comfortable. But in terms of your question specifically, costing is down. Costing is down just because there's no work. So we're able to build our buildings at a lower cost. But having said that, I'm glad Brad's here because he's going to clean up the city for us. It's an absolute mess. We thought it was challenging 5 years ago. The last 4 years, particularly, I guess 3.5. That's been an absolute nightmare dealing with the city on a municipal level, dealing with planning and getting permits, executing things. So glad Brad's here. Yes.
Me too. So then on that note, Kaylee, from the consumer's perspective, Gary says prices are probably going to be getting cheaper-ish. They can afford to build for less as costs come down. Is that one of the biggest hurdles for buyers right now? And what, I guess, in addition to cost of pre-construction, what are you seeing the biggest inhibitors to the buyers are right now?
Yeah, it's a good question. So right now, I think the biggest challenge that we have is just people, it's not them going somewhere else, buying anything. It's just not buying at all. Especially in the end user market. We've got downsizers, especially at our project that we have in Oakville, where they're fine to sit in their house. They're concerned about the market. They're concerned about their retirement plan, their retirement fund. So, they're okay to sit and wait. They love something, but be like, you know what? We're okay to just wait for a little bit. And then the flip of that is the first-time buyer or even the secondary buyer where they're also worried. I'll rent. I don't need to buy right now. Renting it or purchasing is going to make my cost of living higher. So why wouldn't I just stay where I am right now and rent? And then the secondary buyers saying same thing. They're fine where they're at. They've got low mortgage payments right now, especially with interest rates when they bought, say, 5 years ago, coming up for renewal at 1.7, what it was at the time, and now it'll be a lot higher. So maybe we'll start to see them start to make a move, but currently that's the biggest hesitation we're seeing is just not doing anything.
Wow, and I think it speaks volumes when you just mentioned the different profiles there, right? It's certain profiles that are buying, so getting very intentional with what investors and buyers are looking at, where there's going to be a resale market in that geographic pocket in the future, right? That's why we're very specific with what we do. So then, Brad, on that similar note, in that frame, from a planning and policy perspective, what's the biggest barrier to increasing housing supply right now? Just red tape, zoning, approvals, infrastructure constraints, because based on their answers about difficulty, is it insulated in terms of value because that difficulty adds value to the end user in a sense? And if we do make it easier, I know it's a longer question, but if we do make it easier for those guys, does that affect us on the resale market where prices kind of come down overall? How is the investor protected? I can condense it to how is the investor protected while reducing costs, and is that even possible from a policy perspective? That's a big question that I personally even have.
So that's a lot.
It's a lot. Biggest challenge, pricing down. Yeah.
As we go through this, but I would say at the 30,000 foot level, the biggest challenge right now in the city of Toronto is you have an administration, in Mayor Chow, and also the bureaucracy that is at odds with market-driven solutions. So you talk about the investor, obviously folks here in the room believe in market-oriented solutions. We now have an administration that's not a focus, that is not a prioritization in terms of time or policy. And what I mean by that is if you look at some of the social media posts that Mayor Chow has made, she will point out that last year 7 out of 10 new housing starts in Toronto were public builder mall. So they're out there planting the flag that the city has become 70% of the new housing starts here in Toronto. Like, that's a good thing. To me, that's a red flag. That's alarm bells going off, right? And so if you look at housing starts over the past 30 years, we're at a low. And I think you guys are seeing that right now across the board. And so local government's job, and you talked about the different ways that we touch it, but it's really to create the conditions where you can go out and build, where the performa works, where the projects are financially viable. Anthony was talking about some right here, the programs that exist from CMHC that help improve project viability, that make them more financeable. But the city and local government has a lot to do with that as well in terms of our taxes and our fees and our process and the timelines. We can get into the specifics of that. But I would say at the 30,000 foot level, it is really that we don't have a bureaucracy or an administration that is aligned around market-oriented solutions. So the programs and the policies that are coming out are not directed towards that. And as a result, we are in this 30-year trough, and we do see, the public sector sort of leading the way on housing starts. And for a variety of reasons, I don't think that's sustainable, effective, or a good use of taxpayer dollars.
Is there any policy that exists today that you would say looks good on paper and the intention maybe made sense, but actually is more detrimental or is actually not working? Is there anything that comes to mind in that regard?
There's a ton. Generally, the road to hell is always paved with good intentions. And I think that's very much true. The development and planning sector, basically every planning policy, and I should say my background's in urban planning. I used to work in the chief planner's office before I ran for council. So I describe myself as a reform bureaucrat. But most of the planning fundamentals here in the city of Toronto are dogmatic in their sort of origins. They are post-amalgamation, really goes back to our 2003 official plan. But all these things need to be challenged. All these things need to be tested. The sort of Toronto architectural vernacular of the wedding cake, that adds costs, that adds expense. The setbacks, that adds costs, that adds expense. That makes housing more expensive for end users. The idea of a shadow on a park, You know, we talk about that as a really negative thing. And yet in the summertime, people are seeking shade. You know, people are seeking trees for comfort, you know, for that shade protection. You look at planning precedent photos in TED Talks, and they're European streets that are like, you know, 4 meters wide, and the buildings go up straight, you know, 8 stories. And we talk about how fabulous that is. Totally illegal, not possible here in the city of Toronto. So you start pulling on all of those planning fundamentals here that have really dictated urban form over the past 20 years, or you talk about some of the engineering stuff, you know, the green standards, the bat tubbing, that are all, you know, performa breakers now when we institute that sort of stuff on every project across the board. So you asked if there was one thing. I'd say there's like a million things. But again, it goes back to the fundamental idea of what is the job of local government, you know, and I would say it's about creating the conditions that are consistent, transparent across the board for everybody, and predictable, and that are not having local government stand in the way of the thing that we say we want most, which is housing, but actually being a partner in trying to unlock housing across the city. And that's a change in mentality that we're going to have to reorient City Hall around.
Great point. Great answer. Yeah, I'm looking forward to seeing all these things that you do. So Brandon, then on that note, just speaking about policy and whatnot, how does that affect the way you guys deploy capital, and how does that affect the intention behind the capital? Like, you guys are international, so I know you can speak to GTA, you're obviously here, but you're also international. And I just want to know, what is the thought behind the deployment of capital now from an asset class perspective, maybe, and then from a political outlook perspective? How much do politics impact that decision?
Yeah, it's a big part for, and I think obviously policy plays a huge part in, you know, you mentioned it earlier, the kind that it takes from acquiring a site or delivering units. So when you work through planning, approval, obviously markets change, costs change, buyer demand changes, all those things, and that all plays an impact in where we're looking, what we're looking for, and where we'll invest. I think what everyone's kind of touched on here is, you know, we're kind of a few challenges within the residential space today. One being consumer confidence, people being out in the market, people buying units. That's obviously a key driver for any development to move forward. So that uncertainty really, you know, making it very hard. And two, I would say, is really making the math, you know, what costs are, what buyers are willing to pay, what costs we have to pay from a development charge perspective, from a planning, obviously interest rates, and we're putting debt on the land acquisition, and it, you know, should take us 12 months or to that process, but it takes us 48 months. That's an added cost that ultimately has to pull through.
Delays returns.
So again, I would say, you know, from an asset class perspective, you know, again, I think everything you touched on earlier, we see a lot of great fundamentals in the market. You know, candidly, I would say there's a little bit of a nervousness of what may come if we don't fix this problem of the supply and demand imbalance. You know, we're not a city that, when we have the continued population growth, that can go through 2, 3, 4, 5 years or very little deliver. That's going to have a huge impact on pricing, what happens in the market, etc. So again, I think we believe in a lot of the fundamentals. And again, it's getting a little bit creative in terms of where we need to force asset all, that we think we could take advantage of those fundamentals, but not taking on a big risk in terms of, you know, what does that time bring to the market? Where's the market going to be? Where interest rates going to be?
Is there anything really specific you're looking at right now that's maybe different than what you were looking at pre-pandemic? Is there anything maybe more relevant to the market today that we should be more cognizant of?
Yeah, I think, look, it's, I would say kind of where we look across obviously all parts of the residential market. We kind of continue to try to expand our thinking and look into different asset classes within the broader real estate market, whether that's, you know, data centers or self-storage, vertical rentals, obviously residential, seniors housing, student housing, etc., to try to see how we're at with that kind of work. But again, I think within the residential space, you know, again, looking at what's happened in the market, and going back to Anthony's point, you know, housing is a fundamental need. So we're trying to kind of look at that and identify where is the opportunities. Again, going back to the multifamily rental space, you know, again, the rental rates, the NOI, generally, if you're buying good assets are performing well. You've seen kind of the opposite side, or cap rates and how these things are valued. It went in some markets, they increased by 20, 30, 40%. It obviously impacts the value. So again, I think we see an opportunity in that marketplace where if you're buying good assets that are well located, that there's a very story told that has a stability. And I'd say that kind of plays into, how we're looking is I would say a little bit more defensive. Sure. You have to, when you're going through this side and there's a lot of layers of uncertainty, you want to be a little bit more defensive in where you're forecasting.
And I guess ready to pivot and be adaptable and kind of let the market dictate most of what you're doing. Exactly. And I think for, I guess, the developer lens and the sales lens, in terms of that end consumer, I'd love to know more about how that profile or those layers of thought go into maybe the design process and the sales side. So what is it the consumers are really valuing today, and what's changed in the way you're building units? Like, Kaylee, from your perspective, what do the buyers want? And Gary, how are you hearing what the buyers want and then implementing that from a design perspective, layout perspective, amenity perspective, so that we can make smarter decisions to buy what we know the consumers want and there's insulation there? Does that make sense?
Yeah, for sure. So I think there's twofold of that on the low rise and then on the condo side. So on the low rise side, we're definitely seeing more focus on how can I find a mortgage helper, whether it's a finished basement, whether it's a home with a secondary suite already built in. We're seeing a lot of families that are looking to buy together to share those costs. So we're seeing, parents with the, kids that are 20 to 30 years old buying with them. They're also looking at, can we suite out a basement? So there is a lot of focus on how can we find somebody else to help us pay this mortgage should things become a bit of a problem. On the condo side, we're seeing people looking for more livable spaces. So bigger unit, looking for, bigger kitchens, bigger living spaces, bigger bedrooms, not a cut programming. So we're kind of having to reshift the way that we're thinking as design, which I'm sure you guys are doing as well, of like, let's deprogram some of this. So does this need to be a den or could it be a walk-in closet? Could we take some of this, the space that we put into, say, like, a storage room, and which storage is also very important, but, could we utilize that space better to be able to offer bigger spaces, more living space, that type of thing? So those are things that we're hearing people are looking for. At our Clayton project, we combo suites have, you guys have done this as well, as we found when we initially went out. We did have suites that were bigger, but there was a really strong demand for even bigger units. So we looked at, okay, so how can we create this? So taking, two smaller units, combining them to be one bigger unit, and kind of repackaging.
So you're seeing that buyer as well, like you're seeing the buyer that wants larger space, because there was that trend to density and smaller and tighter, and then obviously I'm going to ask you follow-up questions on what the city's defining as livable, but now it's almost the inverse. So we're seeing density, but a whole new buyer profile.
Yeah, absolutely. So seeing, and it's interesting because, we've heard a lot of comments from people, well, I won't look at condos because they're just putter shoe bosses. So they opt into us account. So we're starting to see, we're having conversations with people that are saying, well, I won't look at condos. I'm not going to look at townhomes because I can't get enough space. It opens up the conversation to talk further about, well, how much space are you looking for? You're looking for 1,500 square feet? Cool. We actually have that for you. Why don't you come and take a look at it? If you're in a condo, it's close to a townhouse, but you have it all over one living space. Sure, like one space is close to moving stairs. So it's just opening up the conversation with them a little bit further to really find out what their need are is, what their hesitation is with condos, to see if we can maybe fill that need for them.
I love understanding the thought process there. And Gary, similar.
Yeah, what I would say though, just piggyback on that, is the development industry, frankly, for the last 15 years, the last big, I've really done a disservice to the city in terms of what they built. These shoebox cookie cutter homes are not what people want to. Mostly those were just sold to investors, flip, and to rent out or whatever. And people don't want to live like that. We've always kind of maintained that our buildings are livable. So our buyers are people who want to live in our building. We've had family size units. We've concentrated on design. We've concentrated on livability, wellness, architect, those type of things. So the number one driver, really, we can do all that. We can say all that, but sales are slow right now for everybody. And the number one driver right now is just cost.
Absolutely. Yes. Yeah.
You know, we're all trying to compete with each other to do the livable, do wellness, design, but the number one thing.
At the core, it's price. It comes down to price. Price of in terms of just the core price of the asset, or more the affordability with the deposit structures and down payments, combination of both. So then obviously you're more, I guess, in tune with the consumer, I would say, because you're talking to them and have that communication. But Brad, from a political perspective, maybe you can speak specific to city, but also the mindset of government. How do you listen to the consumer to allow the developer to do what the consumer wants versus trying to predict what the consumer wants, right? Like trying to predict what everybody wants versus what the buyer wants. Is that fair enough?
Yeah, I don't think we do a particularly good job of listening to people. I think we have an idea, and people get passionate about a particular solution, but the solution might not be the best thing to address the problem. And so for many years in Toronto, we've talked about the need for 2 and 3 bedroom units. We have guidelines, policies around this, or growing up guidelines that stipulate the percentage, usually 20% of 2 and 3 bedroom units that we want in a condominium. But then we whack you with more development charges on a bedroom basis and actually make that product more expensive. And so I'm curious, like I get that people want more space. We all want more space. But what is it in downtown Toronto? Is it like $1,200 buildable right now? So like with every additional square foot, that is more cost. So from a local government perspective, you start asking the questions, okay, what is our role in driving up costs? What is our role in making housing less affordable? And it turns out it's a lot. You know, to your point, labor costs are down right now because you know, the men and women are off the tools, they're looking for work. Yeah. I don't control labor costs. I don't control finance rates. I don't control the cost of construction materials, but I do control the taxes and the fees and the charges associated with development. And in the Toronto context, 30% of the cost of a unit of housing is taxes and fees. And under the previous administration, development charges went up 1,200% over the past 15 years. Nice. You show me any other consumer product anywhere in any sector that has gone up 1,200% over the past 15 years. I'm not aware of anything else. And yet, to your point, with your deck off the top, you know, housing is a fundamental for people. So when you talk about affordability, the biggest bill that you have every month is your rent or your mortgage. So affordability conversation is always centered around housing. For those of us who are still, you know, paying rent or mortgages, which is a big portion of Torontonians, 51% of folks here in the city are renters. You know, the average age and the demographic of Toronto is increasingly getting younger. Those are people who are trying to build some equity, get in the marketplace. And so those are costs that we're thrusting upon people, both in terms of the taxes, also the delays and the cost of time and how that impacts the cost of a unit of housing, which is significant as well. So those are the things that we need to focus on. And again, the intentions are always good when we prescribe the unit mix. Yeah. But again, it has to be driven by what people want in the market as a consumer. And then are those desires for a particular product, is that something that can be delivered in a more affordable way? And, you know, I've outlined some of the things that we can control in terms of cost. We're not doing that right now. You know, I have some suggestions and some prescriptions for that. But right now...
Can you share one? Can you share one with us? Like what one of those would be?
One would be a 25% reduction in the cost of development charges here in the city of Toronto immediately.
You got Gary's vote, I think.
And the trade-off is like, okay, how are you going to pay that? It's about $480 million. My proposal would be to use the Housing Accelerator Fund, monies afforded by the federal government, about $480 million, to reduce the cost of development across the board immediately, 25% reduction. Today, that money is being used to fund the public builder model. So that again is where the city puts on the green patch boots, the hard hats, go swing the hammer and try to build the housing ourselves. And of course, if we do end up yielding a single unit of affordable housing, it'll be the most expensive affordable housing in the country's history, because anybody that's been around local government or government at all knows that we don't typically do it faster for less money than the private sector. Sure. And I actually don't think that's the problem right now. I look around the city, I don't see a shortage of experienced builders who have the expertise and the capital and the desire to get out and build. I just don't see market conditions, you know, and bylaws and policies that really support those efforts or those ambitions right now. So that's some commentary, I guess, on on unit mix, which is where we started.
I like it. No, yeah, no, it's great. I think I guess overall then, in terms of timelines and the length of timelines, obviously you all have different maybe similar opinions on it. Everybody wants to speed it up. But do you ever find, I'm not going to ask you how we're going to speed things up, you've heard that 1,000 times, but do you find that what you prepared for and what you planned for, if it's a low-rise 2-year phase or a high-rise 7-year phase, do you find that this preparation and this thought and this plan, do you find that generally you're pretty right by the end of it? Or do you find that because of that length, we're actually building something that may no longer be as relevant to the market, right? Like if electric cars are the craze right now, but it takes 7 years to build a Tesla, in 7 years' time, we've invented hydrogen-powered cars, and now no one wants to pick up their Tesla, they go to hydrogen-powered cars. Does that make sense? Like the trends and what's happening, we predict as much as we can, but because of the timeline, it no longer aligns. How does that play into your decision-making? We can only predict so much.
Yeah, I'll just say, I mean, again, I think exactly what you've described, we're seeing right now. 4 or 5 years ago, the very small shoebox style condo was just the easiest product to sell. And it was price point driven and return driven by investors. And the hardest units to sell were the 2 or 3 beds. Again, we could prescribe, we have to sell those. Yeah, those were always the hardest units to sell and generally weren't selling until we were close to completion. And again, when you think about it logically, it makes sense. If I'm a young family and I want to buy a 3-bedroom condo, am I buying something I'm going to move into in 5 years? That's a hard decision to make. If it's, I'm an investor, I have a kid in university, I could buy a small unit and either they're going to move into it, I can rent it out, I can flip it. There's a lot more demand for that. And again, I think, the market's always changing and moving and there probably isn't a perfect answer to that because you can't build a high-rise tower in 12 months. So, markets are going to change and evolve, but you're definitely seeing the impacts that we're living through right now, where we've got an influx of one type of product that's come up to market that's fallen out of favor in terms of buyers, investors, and ultimately renters as well.
The one thing I would just quickly add on that is the answer is to be less prescriptive. Yeah. Like government in general, bureaucracy in general is really good at doing the same thing over and over and over again. It's set up that way. Like you go to the passport office, there's a process for that. It's repeatable. It's the same across the countries. Yeah. What we're not good at doing is embracing innovation, having flexibility, or being able to respond to changes in the market, changes in policy, changes in vehicle technology, whatever. Like we're not good at responding to that. Great example would be, you're all familiar with the sidewalk labs saga down on the waterfront. People have different views on that. But one of the fundamental hangups was local government, the city of Toronto, the previous mayor at the time, threw up their arms and said, well, geez, data privacy, digital governance, we don't have a framework for that. Well, of course you don't have a framework for that. This is like cutting edge, tip of the spear stuff. Right? So just because it's hard or we don't have it doesn't mean we ought not to get there. But as government, we need to be able to respond and to be more flexible. So I think broadly, the way you deal with this is less prescription, less regulation, a more openness and a willingness to try new things, embrace change, and really say, like, again, if the top line goal is more housing, we don't need to dictate how that happens. We need to create the conditions with an openness and an embrace to innovation and trying new things so that market partners can help us get there in a way that makes financial and economic sense for everybody now.
I think that's a great point. I'm aligned with that. Let the private side do what they do best and enable that environment for them to succeed, right? Essentially. Get out of the way when you have to and create the environment. Any thoughts on that in terms of timeline and maybe making changes and adjustments throughout that 7-year timeline? Like how often are you changing on the fly, changing suite mixes and changing designs based on new information? Or is what we predict generally pretty, makes sense? Like our predictions are pretty...
Well, the market now is so much more challenging. Before you didn't have to change because you were all sold out and there was no need. Now, when you have inventory and you're going through the process and your sales aren't there, you have to be fluid. You have to make changes. And we've talked about that. We had our studios and we've incorporated those into, larger suites now, more 2 and 3 bedroom suites. So yeah, you have to be fluid. Before you didn't have to be, now you do.
Right.
Yeah, it's interesting going through finished product now that was, that was bought or sold, I guess, at the peak of the market. You go through some of them, so you're like, oh, like, what were we thinking? Yes, I that. But like we have to live with it now. So we have to try and sell it and I would say like 4 years ago, internal bedrooms, no problem. And now it's like 50% of the people like them. 50% are like, no, thank you. Don't even show that to me. So we have to try and overcome that. Like, how do we get somebody to fall in love with it or make it make sense to them? It's about price, or, do we try and make that a den or something like that? Like I said, deprogram them to make them work for them.
Do you think we're in a better position today to make predictions than we were a year ago, based on buyers and profiles and outlook?
Absolutely. Absolutely.
Yeah, I think so too. I guess if I could just get your take on the future of the GTA real estate market from your specific lens. What's the take? What's the outlook? Feel free to make it your own, tweak the question a little bit, but based on where the money's going and building starts for you.
Yeah, look, I think, as I said, I think we see a lot of fundamental strength of the market. How quickly we get there, how the end consumer reacts to what's happening in the market, the uncertainty in the market, I think is candidly a bit of an impossible question to answer. But we believe in the market fundamentals and again, what product mix, how it's going to be built, when it's going to be built, the process for it to be built is all things that we're trying to work through.
And you're actively investing money in the GTA today, right? Like, and confident enough to put your money there.
Yeah. And again, I would say for us, a lot of what we're looking at within the market today is, again, from a equity kind of developer perspective, is a lot longer term. Because again, I think we unfortunately feel that there is some headwinds in the market, and it's not going to be a simple flip of the switch and the market's going to turn back on and be in a great position. But as you talked about earlier, we look from a long-term perspective.
Which I think generally we always have, right? I think COVID and the acceleration of trends just accelerated the price appreciation in the market, and the expectation was that you could flip a pre-con condo like that, right? And then politics get involved, and we want to limit speculators because that's going to help the market, right? So it becomes this interesting, mix of decision making that doesn't make sense for the long term because people are making decisions for the short term. So back to those fundamentals, long-term decision making, it's better overall, I would say, right? Just harder to get accustomed to. But Brad, I guess from your background, similar question, outlook?
How many people live in Toronto? And how many are outside the city? Okay. What was that, like 60-40 maybe? 60-40? It's interesting. I asked that question because I think 10 years ago, everybody wanted to be in Toronto. Everyone was doing everything they could to be here in Toronto. And there was a pathway to be in Toronto. I look at it less as an investor, but more as like a dad who's 40 with a 2.5-year-old and a 5-year-old who is fighting every day to raise my kids here at East York and be in the city. And it's hard. It's hard to do that. My sister's up in Aurelia. Any Aurelian folks? Like got a house that was half the price of ours on an acre downtown, like 2-minute drive to the hockey rink, no traffic. Like you're looking at quality of life and what are those trade-offs? I grew up in Hamilton. There's good stuff going on in Hamilton. My mom's out Waterloo region. So when you talk about the GTA, Toronto is very much competing with the GTA right now. We are competing interprovincially with markets like out in Alberta. We are competing north-south across the border and in fact around the world. But for a long time, Toronto hasn't thought about competing. We've just rested on our laurels. We've just assumed everybody wants to be here. And they have because of the fundamentals. I don't know which one of you had the fundamental slides, but we have some of the best hospitals in the world. We have some of the best universities in the world. We have a tremendously talented workforce. We're the most diverse city on the planet with 51% of our population born outside of this country. All fabulous fundamentals. But we cannot assume that Toronto's trajectory and our success is always going to be guaranteed. And there's lots of case studies and examples of cities over the past century that have ebbed and flowed. Like Detroit is a great example, but even more recently, San Francisco. 15 years ago, San Francisco, like you do everything you could to be in that market. And then for a variety of reasons, in part politics and leadership, it started to track in the wrong direction and became a less desirable market. And people were leaving San Francisco. And I think that is the biggest risk to Toronto, and forgive me for being so Toronto-centric, but is that we cannot assume the success that we've had over the past 2 decades is guaranteed on a go-forward basis. So am I bullish on Toronto? I'm bullish as hell on Toronto. I am all in on Toronto, but it is not lost on me that it is a fight every single day to be here, to make those mortgage payments, to pay the childcare fees, which are higher in this market, to spend an hour and a half from, Danforth and Woodbine to get my kid up to hockey practice at Downsview, or when I ride the TTC and somebody's smoking crack on it. Like, this is where our city is at right now. And I'm very honest and sober about that with people. Yeah. And we need to make some fundamental changes in how, our expectations. We have to shake off this resignation towards mediocrity where we just sort of justify a canvas in the park and just sort of say, well, it's Toronto. Like, none of this stuff is good enough. Yeah. And it ought not to be good enough. So the fundamentals are sound, but it would be a big mistake if we just sort of sat back and continued to do the same old, and without making some fundamental changes on our trajectory on a go-forward basis.
You're obviously not very passionate about what you do, eh? Come on, man. No, I think that speaks volumes. I think a lot about competition in the private space, right? Developers competing, design, whatnot. But I haven't thought about it from the public perspective. And you're right, Toronto is a phenomenal city, but we're losing that attraction. I think for sure there's more Toronto people here, but they're like, yeah, I live in Toronto, right? Like, maybe nervous about it.
Look at like Miami, look at Dallas.
It's
look
different.
At Calgary.
Yeah.
These are
People are proud to be there because of the innovation.
Yeah.
I like the fact that the innovation is looming, right? That competition is looming. We have rested on our laurels, and you're going to fix that. Right? Gary, same question. Just big picture outlook, real estate market, GTA, Toronto. What are you thinking?
I'm not as pessimistic as these boys. I've been in the game for 40 years, so I've been through a lot of recessions. And you talked about it from earlier. People act as a herd. They don't act individually. So I think when the market turns, despite what you guys were saying, I actually do think it's going to be there's going to be no supply, and then you're going to be back into a boom situation. Yeah. I don't know when that will be, whether it's 3 years, 4 years, 5 years, but I think that's where we're going to end up. But to Brad's point, I do think this city really does need a change. I live right downtown, right in the city, Dovercourt and Queen. And my neighborhood in the last 6 years has just totally disintegrated. And if you don't clean it up, who knows?
It doesn't matter how great your buildings are. It's the surrounding, right? And it's all about location.
Smoking crack to get into your building.
Yes.
Yeah, no, great point. I think that the intention is there, and as the intention comes there to innovate and make it a better place to place money, be more attractive for investors overall, the opportunity is huge. But I'll give it to you, Kelly, for the final thoughts on the future of the market.
We're also very optimistic about the market in Toronto. Our company's also been around for 40 years, and our chairman, Garnet Watchorn, he's been in the industry forever. He comes by my desk every now and then and goes, "What's happening in the market?" And we're starting to see a lot of institutional investors that are starting to come out and look at inventory sales. So they're seeing that now there's a great opportunity in the market to pick up inventory and help it to get through some of the supply that we need to get through before we come out the other side and start to see appreciation and growth start to happen, not only on the rental side, but also on the sales side. So we've got 3 buildings under construction right now. We're actively looking at sites. We see this as a really short-term opportunity to be able to get into the market. And I think there's some great deals for people right now. Like, if you're optimistic, you love Toronto, you can see the fundamentals that this market is going to shift. It's going to change. It always does. It's a market. It goes in cycles. There's some really great opportunities for people.
Time in the market versus timing the market. Have you heard that tacky one? Yeah, but it really is relevant today.
Yeah, I mean, those that bought pre-construction, say, in 2021, right now they're like, oh my gosh, I've lost money on it. But just wait, don't sell it right away. It's the speculators that I think are being hurt the most. And it's unfortunate because, you had this vision and buying real estate is probably the biggest investment anybody's ever going to make in their life. And if it's down, as best you can, just try and hold on to it because it will come back. It's, you said, prices double every 10 years. So we're very optimistic.
Can we get a round of applause for our panel, please? You guys were phenomenal. Thank you. We're right on time when I was anticipating to end. We just started a little late, but we've got a little bit of time for questions. If you guys have any questions for anyone up here, general or specific. What do you got? They answered everything already? Nothing? You don't ask Brad where he gets his hair cut? Like 0 questions? Come on. Yes?
I have a question for Brad, because I know recently Olivia Chow, the new luxury land transfer tax and everything, and obviously kind of having them take the brunt of it. But what do you think would be some of the most impactful changes the government could implement, specifically in Toronto, for that first-time buyer? Because taxing, the luxury homeowners more doesn't actually make it easier for the first-time buyers to get in the market. So is it land transfer tax? Is it further government funding? Like, what do you see as the biggest solution to help that affordability piece for the first-time buyer?
Well, you get it, and I wish our mayor did, that any tax on housing anywhere is going to make housing more expensive for everybody. There are downstream impacts. You peg it at $3 million, like there are downstream impacts, in terms of affordability for everybody. The last time we had an NDP mayor, David Miller, sorry to be political, but it's political. Last time we had an NDP mayor, David Miller, he had the bright idea of the AA transfer tax, which we're all very familiar with. I think it was 2006. We're the only jurisdiction in the province to pay it, both to the province and the city. And it's very real for people. I remember when we were closing, my wife and I on our place in 2016, and I felt like a bit silly because I hadn't totally anticipated how significant that cost, but it worked out to basically 12 years of property tax upfront at a time when you've never had less amount of money, because I had $6 in my checking account. Like everything was in on that. So it was huge. When they brought it in, they talked about providing some relief for first-time homebuyers. It was $400,000. Do you know what it is 20 years later? It's $400,000. So that's something that I am looking at, because again, I still believe that for a lot of Canadians, there is a dream to have home ownership, a pathway to home ownership, a pathway to building equity. I think people want that. And so that's something that we have to look at, because that is the relief that's been provided for the past 20 years is not reflective of where the market is today. And I've actually moved to motions at council, which of course were not supported by the mayor and my colleagues, but to bring that in line with, inflationary prices today was something like $8.90 or something in today's dollars. Because I think that's important. And again, if we talk about the attractiveness of Toronto, Toronto is in part attractive if you believe that you could actually buy property here, that you could actually be a part of that market. If not, you're just like, Toronto's not for me. I'm going to Durham region or whatever. And like the reality is, guys, 70,000 people left the city of Toronto, 77,000 left Toronto last year in a fight for affordability to other markets. You know what the number one demographic people leaving the city was? Age bracket? 0 to 5. 0 to 5. 0 to 5. Because as soon as you have a kid, you're out of here. And so, like that's something that we have to be much more alive and aware of. So, that's something I know again.
I think from the pre-construction perspective, it helps delay that big upfront cost, because the rental market is fine, right? Even the luxury rental market is fine. It's the monthly, generally, the market can afford. It's coming up with that big down payment plus closing cost that's so difficult to buy. And just again, another consideration for the market and the growth of the market is pre-construction is a phenomenal option in the low-rise space where you guys are and high-rise space. It just delays that land transfer tax and closing costs where you can account for it more effectively.
C.D. Howe wrote the best paper on that, though. C.D. Howe Institute wrote the best paper on luxury home taxes, these taxes, and the downstream impacts. So if you haven't read that paper, Google it. It's a good one for all of our knowledge and understanding, although it's pretty straightforward. But obviously that drives up prices right below the 3 mil, and that cascades the person, the 1 mil, tried to move into the 1.7 mil and all the way up the property ladder. But that's the reference document I read.
Are there conversations getting had, though, around eliminating land transfer tax? Because that is a big, especially in the city of Toronto, you get hit with it twice.
Yeah.
Is there conversation, and that isn't financeable, so it does add to the affordability concerns people have. Is there any conversations around that?
Yeah, like TREB, Toronto Real Estate Board, has been advocating for that for years. I moved a motion to provide additional relief. I think I did that twice through the budget cycle. you know, it's interesting where now would be a good time to do it because transactions are so down. You know, the problem was this was never supposed to be something that we were paying our operating costs with. It was always supposed to be for capital. And yet we have been financing our operating costs pretty much since it was brought in on the backs of the AA transfer tax. So you look at development charges, I think, don't direct quote me on the numbers of the years, but I think 2022, we were at peak at $942 million, almost $1 billion. This year, we're on track for 110 million. So that, like, it's crazy. We're like 15% of what we were at peak. So transactions are way down. Nobody's starting anything. And I agree, you know, Gary's point that whatever it is, 30,000 surplus units in the market, that is a finite amount of supply. Maybe it's 36 months, maybe it's 48 months, but we will never be able to make up the gap on the housing that we didn't start last year, this year, or next year. So at some point, rubber's going to hit the road on that. We're going to hit the cliff, and prices are going to skyrocket because we haven't started anything, which is a big problem.
My big takeaway there is that a lot of the political intervention generally, not always, generally seems to be reactionary. In a hot, crazy, sexy market, it's to limit the growth. And right now, hopefully, there are some mechanisms put in place, I'm sure they will, to re-stimulate the market, right? Such as land transfer tax and whatnot. So it is what it is. Any other questions? We've got time for maybe one more quick question.
That luxury land transfer tax that is definite going April 1st?
Yeah, it's the three, so two different, the luxury homes tax, yes. I voted against it. 5K, no, but it cost, but it is happening, yeah.
All right, good. Nice quick question to finish off. Thanks for coming, guys. Appreciate you. Thank you.